Good evening, everybody. Delighted to be here with you this evening. I'm going to try and be very disciplined on time to leave plenty of time for questions at the end. I'll just start with a quick introduction to our firm, Lazard. We actually have two businesses. On the one side, we have our financial advisory business, and we also have obviously the asset management business that I'm part of. We have roughly about $200 billion of assets under management, 900 employees, very heavily weighted in that regards to the investment side in terms of people running the business. And from a client perspective, we are traditionally a institutional type asset manager, which is why we are particularly excited and pleased to be taking responsibility this year for the Wynd Investment Trust, which we are going to be running and implementing alongside and completely in line with our established global quality growth strategy that has been running since 2011. Just quickly, by way of background, I run this portfolio with my colleague and partner, Barnaby Wilson. As you can see, we have both been investing for a long time. We've made quite a few investment mistakes along the way, some few bumps and scratches and a few scars. That has helped us to refine and develop our investment philosophy and to build a very, very strong conviction that the best way to generate attractive levels of performance and alpha over the medium and long term really is, we believe, to invest in high quality companies. What we mean by that essentially is that great businesses can make great investments. What do we mean by great? Well, we think it comes in two important forms. The first is we're looking for companies that make persistently high returns on capital. In that way, we believe that they are generating strong value for shareholders by producing returns on capital well above their cost of capital. And the persistence of those high returns is derived from the economic moats that protect the business from corporate intruders, I would say, hence the graphic that we show on the right-hand side. So we're looking for businesses that make great returns today and have something special, a competitive advantage or an economic moat around their business that protects those returns on capital and allows them to endure into the future. The second element of a great business is one that has is where it has an ability and an appetite to reinvest back into itself in order to drive growth. And it's the combination of those two factors, persistently high returns on capital and an ability to reinvest back into itself, that creates, in our view, a very powerful and a very attractive compounding effect on cash flows, earnings, and shareholder value. And that's what we think creates alpha. And I'll just talk a little bit about that compounding cycle, as we call it, because it really is underpins what we're looking for in all of the companies that we invest in. So it's actually a very simple concept. It's underpinned by that green box in the middle. So when I talk about financial productivity, I mean a business's return on capital or return on equity, or our preferred measure, which we look at, which is cash flow return on investment. When you have a business that produces high financial productivity, it will produce strong levels of cash flow. And if that company can reinvest a proportion of those cash flows back into itself, into new investment projects, it will create a larger capital base. And if in the following years it can maintain those high returns on capital on that enlarged capital base, that will result in higher levels of cash flow in the following year. And therefore, if the company continues to reinvest, then we can go round and round in this cycle. And what we see from that is growing levels of cash flows. So that's the concept. We show that in a real life example in a company that we have been invested in for well over 10 years, Taiwan Semiconductor. We show you here in the middle chart that it has consistently produced over the last 20 years returns on capital nearly double the level of the global average at around 15%. At the same time, it has very significantly reinvested back into itself in new technology, new capacity and scale, growing the capital base, and thereby in maintaining its high returns on capital or its financial productivity, you can see the cash flows that have been produced and the growth in the cash flows that have been produced over the last 20 years. And you can see the stock price that has followed. And we deliberately picked Taiwan Semi because we know that it operates in a cyclical industry, and many people would believe that in order to generate returns in the semiconductor industry, what you need to be able to do is to time and get in and out of the semi cycle. And that is not our approach. We believe that our clients would have been better off served by simply establishing the conviction that Taiwan Semi was going to be a long-term winner in this industry and to remain invested throughout all of these cycles that have taken place. And that really is our approach to looking for these compounding businesses. And so the resulting question, I guess, is, well, that's all very well, but why is it that these compounder type businesses are consistently undervalued by the market? And we think they are undervalued mainly for the reason that the market doesn't believe that this compounding effect on cash flows and earnings will last. And the reason why the market believes that is the case is because it believes that the financial productivity, the high financial productivity, will not last. And the reason why we think the market makes that assumption is because the economic law of competition tells it to make that assumption. The economic law of competition would prescribe that companies that generate high returns on capital, and here I'm showing you the IT service company Accenture as an example, the reason why the market makes that assumption is because it assumes that those high returns attract competition, the result of which means that the returns get eroded over time down to a corporate average or a cost of capital. And we simply believe that you cannot make that assumption for all companies that are generating high returns on capital. And it's some companies that have enduring competitive advantages will allow them to resist that competition and thereby resist and beat the fade. And when we believe that when companies beat the fade, they will beat the market. And if the economic law of competition worked properly and in all companies, then you wouldn't have seen Microsoft being able to deliver the returns it has for the last 30 years, Coca-Cola delivering high returns for the last 75 years, and Louis Vuitton for the last 150 years. There's something special about these businesses, the economic moats or the competitive advantages that they're able to develop and nurture that enables them to maintain high returns on capital for longer than the market expects. And therefore, the two insights that we need to develop are really, one, we need to be able to identify those businesses that are going to allow their returns to last for a long time. And two, we need to work out what the market is pricing in today in order to conclude that we have this mispricing opportunity. And the way in which we do that is by good old-fashioned fundamental research. And in that regard, we are enormously helped by the fact that we have at Lazard an internal research team of about 70 analysts organized across 6 super sectors here. And they will spend their entire careers becoming the experts in their industry, really developing deep knowledge of the companies that they cover speaking to their, not only to the company management, but to their suppliers, to their competitors, to their customers, to the regulators, to really be able to build up a strong picture of their industry and to help us identify the companies that they believe will be the compounders of today and of the future. And when we're doing that fundamental analysis, these are the 4 key questions that we look to satisfy ourselves about, which we show on the right-hand slide. The first 3 questions relate to the operating characteristics of the business and help us determine whether the company meets, in our minds, our definition of a compounder. The first 2 questions are about the returns on capital of the business and how long, whether they are high enough and whether we think they can, how long they think they can last for. Both of those 2 questions, to answer them, we delve into trying to develop a deep conviction in the competitive advantage or advantages that the business enjoys. That is a very, very strong focus of our team and of our analysts. And we show here on the left-hand side some of our very favorite competitive advantages that we've invested behind. Some of them will be well known to you, I'm sure, like brand or scale. Others perhaps less so, but we feel no less important. So we do like finding businesses that dominate niche industries. We like finding businesses that make a critical product or service for their customers, but where that product or service represents a very small part of the customer's cost base. And we also like finding businesses where the person making the decision to buy, purchase, or procure that product or service isn't the person actually paying the bill at the end of the day. So we work very closely with our analysts to understand what makes the business great. And we work very closely with them and speak with the management to understand what reinvestment opportunities the company has. That allows us to determine whether we think the business is a compounding type business. Then the 4th question is around valuation. What we're trying to do is to derive from the share price how long the market expects the current level of returns to last for. And to help us in that quest, we've developed a valuation tool which we call MyCap, which takes the current share price and solves for the length of the competitive advantage period necessary for the intrinsic value of the business derived from the cash flows from that competitive advantage period to be equal to the current market cap of the business. And that gives us a number with which we can triangulate around by speaking to the analyst and also the company management to determine in our minds that this compounder type business, underpinned by the competitive advantages that we show here, is going to be able to maintain their returns on capital for longer than that MyCap that the current share price suggests. So that's what we're trying to do. That's what we've been doing for the last, since 2011. Here you can see the annual performance of the strategy, which we're reasonably pleased with, but always trying to do better. This is a low turnover strategy, so 10 to 15% turnover. The whole concept is when we find these great businesses, we want to own them for a very long time and allow our clients to really share in the economic wealth that these businesses produce. And so the returns that you see in the outperformance that you see in various years is really being driven by the same companies in a range of market environments, which include the very strong years, upmarket years of 2012, for example, or 2021 or 2017, but also in the negative years of 2015 and other years. And it's the same companies that are delivering that alpha rather than us as a portfolio management team deciding that we think the market is going to be rallying or going to be going through a tough period. So this is the bottom-up stock picking and the companies themselves that's delivering those excess returns, but not in all market environments. So the phases of the market where we would expect to lag would be one where essentially where lower quality companies are in favor with the market. And that tends to happen, when the economy, there's a sudden big change in the market's view of global growth, a positive change in global growth. Normally that happens at the bottom of market cycles and economic cycles. So think 2003 and 2009. But it also happened in 2016 when Donald Trump was elected president, and the market took the view that he was going to be the solution for the low levels of global growth. That led to a rotation into low quality companies that the market perceived would benefit the most from a higher growth environment. What we will not do is either try to anticipate those periods or even react to those periods. We will stick to our philosophy and really focus on these high quality businesses, because we believe that over the long term they will win out. The other area time when we expect to lag the market will be in an environment of rapidly rising interest rates and therefore discount rates, and that's what we experienced last year in 2022. But overall, we're very confident that over the medium to long term, this should be a strategy that delivers very attractive patterns of alpha and consistent patterns of alpha as well. So the next slide here I show you is the rolling 3-year return of our strategy relative to the market. Anything above the 45-degree line is an outperformance. And you can see that these are monthly plots of these data points. You could have invested in the strategy at any month almost over the last 10 years. And on a rolling 3-year view, you would have seen alpha from your portfolio. And it gives the portfolio overall a quite attractive balance of alpha, whether we be in a rising market when we're able to outperform the market. So our up market capture is on the gross basis around 107%. But in falling markets, we're able to protect capital. And so our downside capture ratio is only 90%. And this is being achieved through this bottom-up stock picking of 40 to 50 of the best companies in the world. So that really covers a very fast sweep through our philosophy and what we're trying to deliver. I will leave the floor now open to questions.
And just before we get going with those, just a quick one from me. Now that you're managing the trust, is all the holdings, are they now in your strategy, or are you still in the process of transitioning from the old holdings to the strategy?
No, the trust is now completely aligned with our global quality growth strategy. It actually didn't take very long to do. This is a very liquid portfolio. So in order to do that, it didn't take very long at all. And this is we invest in companies generally with a market cap of over $3 billion and always with a market cap of over $1 billion.
That's a couple of questions taken out straight away then. There's next one in the same fashion is, when do you choose to sell? You say you have a low portfolio turnover. What are the main reasons when you decide it's time to get out?
Excellent question. So there are 3 main reasons why we sell a stock. The first is sort of a happy reason, but which is when the share price appreciates to the point at which the market implied competitive advantage period is broadly the same as our expectations or understanding of the business. So at that point, we would determine in our minds that the company is fully valued, and we'd look to take profit on the position. I sort of say that's a half happy case, because ideally we'd like to own companies forever if we're owning these great businesses and they're continuing to produce these high rates of return and compound their earnings and cash flows. But that is one reason why we will sell, number one. The second reason why we would sell is even though this is a low turnover strategy with 10 to 15% turnover, we do want there to be competition for our clients' capital. And so when we find, in the event where we find a business that we have even more confidence in the competitive advantages and we think the returns are on capital are even more attractive and the valuation is particularly attractive, we're prepared to swap one position in the portfolio and replace it with one that's been outside the portfolio. So a small part of rotating capital into highest conviction ideas. And then the last reason is the most unhappy reason, but it's one that needs to be said. It's when we make a mistake. Barney and I have made plenty of mistakes in the past, and I'm absolutely certain that we'll continue to make mistakes in the future. What I mean by that is where we misjudge or overestimate the quality of the business. And when that happens, what we've learned over the years, and also the hard way, is that when we make a mistake on the compounder element of the business, the best thing for us to do is to recognize that mistake, be humble, and exit the position. Because simply hanging on to a stock, and we've done this before, where your underlying thesis has been violated, but you hold on for valuation reasons, and you're saying to yourself, it's just too, I'm wrong, but it's too cheap to sell now. That is, in our experience, a very good way to turn a medium-sized mistake into a big mistake. And so we try and be humble, recognize when we've made an error, and to cauterize the wounds quickly and move on. It's actually the most difficult thing that we do, because we do, to be able to distinguish between a thesis that has been invalidated with a company that's just where the industry is just going through a cyclically tough period, or where the business is having some short-term challenges. We want to be able to look through those two factors and stick with those businesses, and sometimes to be able to untangle where actually it's not that's the problem, it's a root problem with the company and a lack of quality. That's quite tricky to do, but we're trying to get better at that.
A few questions on China. On one of your slides, you had a Tencent logo, and in the broader kind of Chinese sphere, if you like, you talk about Taiwan Semiconductor. What are your views on China?
So what I should have said in my presentation is Barney and I try extremely hard not to take or even to give big top-down outlooks, because we hold our hands up and say that's not where we think we have an edge or a particularly strong skill. And so we don't have, honestly, a better view than the average PM on what's going to be happening in China. We select stocks from the bottom up and from what we can see in going on in the company. Now, that being said, we do have one position in China, which is Tencent, but that is the only position that we have in China at the moment. But we do have companies in the portfolio that do have a meaningful exposure to China. And so we rely on our analysts to give us insights into what's happening in each of those companies' local and exposure within the Chinese market, within their industry.
Question about discounts. The question is saying a lot of investment trusts have been suffering widening discounts. MWY has enjoyed a narrow discount. What is the discount control policy and outlook?
So the discount control policy is to limit it at 2%. And so we will be buying back.
Before. Is that right? That's been the case.
It's exactly it's correct, Roland. It's exactly that. It's a 100% continuation of the previous of the incumbent approach. That will not change.
Okay. Next question I've got here is about gearing. Do you intend to use gearing?
Gearing is something that we are talking with the board about. It's not something that Barney and I have in the long only world, because my background was in long short investing. But in the long only world, we have not employed in the strategies that we manage. If we were to use leverage, it would be to increase the exposure, effective exposure to the underlying stocks. We would not, and it would be a permanent exposure, rather than us using leverage to reflect a market view. Because again, Barney and I do not try and take directional market views in our portfolios. So in our global quality growth strategies, we are always fully invested in the portfolio with a small cash buffer. We don't use cash as a market timing tool